Greetings from 3Edge Asset Management, and welcome to the 3Edge Week in Review for the week of October 19th. I'm Fritz Folts, Chief Investment Strategist here at 3Edge, and I'm joined here today once again by Steve Cucchiaro, President and Chief Investment Officer at 3Edge Asset Management. Today we'll do a quick recap of the recent activity in the global capital markets, and then Steve and I will turn our attention to two topics. First, equity market rotation, and then second, we'll look at the recent increase in yields on U.S. Treasuries. In recent market news, it seems clear that investors are really hyper-focused on the negotiations currently underway in Washington over an additional fiscal stimulus package as pandemic relief. The negotiations are ongoing. And the sense of urgency for such a measure is heightened by the surge in new cases in coronavirus, not only in the U.S., but around the world. The markets are also in the midst of the corporate earnings season, and for the most part, that news is fairly positive, but it basically is overwhelmed by people focusing on these negotiations in Washington, the surge in the coronavirus, and general uncertainty around the upcoming election. Well, what we have seen in the markets thus far in October is that the emerging market equity index, which has a sizable allocation to East Asia, really outperformed U.S. equities. And this is actually consistent with our model research outlook, which continues to indicate that really by any measure, the U.S. equity market is significantly overvalued. So let me bring Steve in here to the conversation, and let me pose the following question to you, Steve. Could we be seeing the early signs of an equity market rotation away from U.S. equities, which have just been so dominant really since coming out of the financial recession back in 2008, 2009? And if we are seeing that happening, what would explain that rotation?
Well, it is true. We've had a trend that's gone on for a long time now, over 10 years. So when a trend has been established for so long, it can be really challenging to call the turn when that trend is broken. But as you can see on the chart, the degree of outperformance of U.S. stocks relative to non-U.S. stocks has been extreme, as well as the overvaluation, the relative overvaluation of U.S. stocks. So we think it's logical to be on the lookout now for catalysts that could break that trend. And one possible catalyst is the idea of transitioning from a tremendous amount of monetary stimulus, the Federal Reserve Board and other central banks literally printing money and expanding their balance sheets, to fiscal stimulus, where governments borrow more money but use that to spend on the real economy. And the reason why that might play a role is that when we have monetary stimulus, as we've had over the last 10 years, without the same degree of fiscal stimulus, a lot of that money stays in the financial system and it inflates asset prices, which are particularly have been good for growth stocks, like what we have in the US. Whereas when you've got a lot of fiscal stimulus, which we haven't seen to the same degree, but we might be on the verge of seeing a lot more fiscal stimulus now going forward, that money tends to benefit Main Street and the economy, and then those stocks like value stocks or international stocks that are tied to value that can benefit from the real economy going up.
That's interesting, and it kind of presents sort of a twist on this idea of if you get a geographic rotation away from the U.S. into ex-U.S., then in some respects, by default almost, you're getting somewhat of a rotation from growth to value, particularly if you think about how those large mega tech companies have so dominated the U.S. market recently. Does that hold water?
Absolutely. So in the same way that we saw this big gap between U.S. stocks and non-U.S. stocks, we also see that kind of divergence between growth and value. And now if you look at the next chart, we can see how from the year 2000 until the financial crisis, value stocks greatly outperformed growth. And then since the financial crisis, growth stocks have greatly outperformed value. Going back to the early part of that period, I can remember in late 1999, early 2000, when growth was outperforming value as the tech stock bubble was building, that we had investment firms who were focused on value strategies who had done so poorly on a relative basis, they were getting out of the business. They were closing shop, or they were changing their stripes and declaring themselves growth managers just at the wrong time. And now, just recently, we've seen some famous value managers closing shop as well. So it's quite reminiscent of that period. But here we are now in 2020, where growth is now at a near record extreme level over and above value. And I do think that this is suggestive that we could be near the turn as well. And so, as you alluded to, because the U.S. has so many technology stocks and other growth stocks, we can think of the U.S. S&P 500 index. Internationally, it's the opposite. Countries outside of the U.S., in particular, a country like Japan, is dominated more by value stocks that can be tied to the health of the real economy. And so part of this rotation, we suggest, is not just about getting out of U.S. growth stocks and getting into U.S. value stocks, but there are even better valuations overseas. And so we are seeing in our own models, in our own portfolios, a rotation now, an opportunity to rotate out of U.S. into non-U.S.
I think that's really an interesting twist to looking at that potential rotation. Going to switch gears here actually from the stock market to the bond market, and I think it makes sense to cover the fact that recently we really have seen an increase in yields, U.S. Treasury yields during the month of October, and most recently even in the past few weeks, where we've seen both the 10-year U.S. Treasury and the 30-year U.S. Treasury. We have seen those yields increase, and so now the conversation is, well, can that continue? And people will point to the fact that, well, if we get a very large stimulus package out of Washington, that could lead to fiscal spending. If Joe Biden wins the presidential election and the Democrats control both houses of Congress, then we could see more additional spending, and this could trigger an increase in interest rates. However, the thing that keeps crossing my mind is that, can that happen, or will it be a situation where the Fed will just step into the breach there and do whatever they can to try to not allow those interest rates to rise? So it's kind of an interesting dynamic. I'm very interested to get your opinion.
So you're right, Fritz. We are seeing the long-term Treasury yields, the 10-year, the 30-year, backing up. Those yields are climbing. And it's largely in anticipation of more fiscal spending. And of course, no one knows exactly how the election is going to play out, but as people have been projecting a higher chance of a Democratic sweep, there's been an increased prospect of more fiscal spending. And could the rates continue to go up? And I would say, yes, they could. And sometimes people need to step back and realize that those long-term interest rates in the U.S. were at all-time, ever since the history of the country's been in existence, all-time record lows. So even backing up a bit is off of a very low level.
Right.
Now, the other thing that is important to keep in mind, other than the very recent past, through almost all of time, these longer-term interest rates have always had a yield somewhere between 1% and 3% above inflation. And today, even though they've been backing up a bit, we're still well below their inflation rate. So there's room to back up. And so I wouldn't be totally surprised. Now, if the rates stayed where they are, it's almost as though they're telegraphing, and it would only be appropriate if it turns out we go into a deflationary recession. And that's not an impossible environment, especially if we get no additional stimulus. However, that's not the most likely case. The most likely case is we do get additional stimulus going forward. So the only thing else that I want to mention is that as rates continue to climb, that just the prospect the Federal Reserve Board having the ability and showing some proclivity to do this in the past, coming in and saying, well, we don't want rates to go up so quickly, so we're going to come in, we're going to expand our balance sheet, we're going to print money, we're going to use those reserves to buy long-term treasury yields, where they usually just buy short-term. Just the prospect of that can make the market behave in a more gradual way rather than in a more abrupt way. So I think something to consider.
Right. So if yields tend to go higher, you may catch a bid, right? Because someone will step in and say, well, I'm assuming that the Fed has our back and will keep these rates low, so they could step in. And then it would be, as you suggested, a more gradual increase.
That's right. And it could also be that the market will test the Fed and
Right.
will drive the rates higher and just see how far they can go before the Fed steps in. So sometimes that happens in the currency markets, sometimes it happens in the bond markets. But I would say overall, given what we had just discussed, this explains some of the reasons why we have already been rotating out of U.S. stocks into international or non-U.S. stocks, and why we've held our allocation to long-term bonds at our minimum because of the prospect that if rates do go up, people who have a high allocation to long-term U.S. bonds can lose principal value because the principal value of those bonds will decline as rates go up.
Thank you. Great. Really appreciate, that's going to do it for us, but I really appreciate your insights there. And it does make me think that as a firm at 3Edge, we do really believe it's important. It's not only what we do, but why we do it. And it is important for our clients to know why we make the decisions that we make, as part of the service that we offer to our clients. So thank you for all the insights. That will do it for Steve and I. We'll be back again next week with another edition of the 3Edge Week in Review. All of our videos, just like this one, are available on our YouTube channel. And please feel free to subscribe to our channel. And all that means is that you'll get a notification whenever we release a new video. If you'd like to share these, that would be helpful too, if you think of someone who could be interested in watching. Also, if you have any questions or suggestions for a topic for us to cover in the future in an upcoming 3Edge Week in Review, you can send those along to us. You just send them to WeekInReview, all one word, at 3edgeam.com. So Steve, thanks again for your valuable insights.
Well, thank you, Fritz. And I also want to thank our clients and our growing list of friends who have been listening. Thank you.
So on behalf of everyone at 3Edge, we urge everyone to remain safe and healthy and to keep the faith during these difficult times. And don't forget to vote. Thanks for listening, and we'll see you next week.